Hello, this is Eric Boyce, CEO and Chief Investment Officer of Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for August 16th of 2026. Got quite a bit of inflation data to go through. One thing that caught my eye right off the bat here was in updating the numbers for tariff impacts and things like that, as it does relate to inflation somewhat. This struck my eye from Torsten Slock at Apollo, and as we all know, some of those IEEPA tariffs were struck down, and so order was given to refund those tariffs, and much begrudgingly, the government has done that, and you can see the impact of that here in this orange category. So these are tariff refunds, which frankly, over the last several months have provided a bit of a stimulant to the economy, and notwithstanding the benefits from the OBBBA Act, et cetera, and some of the other stimulus that's out there, this is actually providing a bit of a near-term tailwind that will not anniversary. This is a one-time deal as we get some of these refunds. Obviously, these represent tariff receipts that are taking money out of the economy, putting them in the hands of the government here, but at least a short-term tailwind. Now we'll get into the inflation data, which we got this past week, both on the producer and the consumer side. I think both really kind of reflect a better than expected environment, to be honest with you. And, you know, when you look at the headline inflation number, it's still 3.4%. So, again, I temper what I said about better than expected by saying at least it wasn't worse than the higher inflation levels that people have already acquiesced to. So 3.4% headline inflation, that was in line with estimates. Monthly data was up a tenth of a percent here. You can see inflation has moved up and has moderated slightly, but still above that level that was established and that baseline for decline that was established back in 2023. Now, you look at core inflation, 2.5%, still above the Fed's target. We'll talk about that in just a second. But it was in line, and monthly data was up 0.2%. You can see that that has a much more kind of a linear downward progression. And again, this is the number that we care about a little bit more because it strips out food and energy. If we slide over here and look at contributions, again, we've got headline inflation of 3.4%, which dovetails with what we see here. And then, you know, we'll break this down. We've got several different charts for you, like core goods, relatively benign, core services actually, you know, below the overall level of inflation. So, you know, these are certainly helping to drive down costs, but and then energy and food on the headline number, as we'll see, were actually quite benign. But again, the reason why we do strip these out to determine core inflation is because these two components can be extremely volatile. Now we look at the share of the overall CPI basket that is running at over 2.5%, and we can see that here is declining. So right now, as we look at this, the 6-month moving average here is right about 50%. So in other words, half of those components that make up the CPI, the all-in CPI, are tracking above the overall 2.5%, 2.5% annualized inflation, and half of them are trending below. And again, we saw a bump there with tariffs, and we see that coming down a little bit. Obviously, we'd love to see that continue to decline, but again, if you go back many years, I mean, typically you're going to find your bottoming out is here around 40%. Now we look at gasoline. Gasoline price is a little bit lower, but again, this is volatile. Again, news flow can change on a daily basis. In a positive development, although this doesn't apply to all categories, and we'll see this in a second with beef prices, but food prices on a month-over-month basis were down. So negative print here for gasoline, fairly benign print for food. and that's why your all-in number was probably in line. Now we look at core goods and core services inflation. You can see here the interim trend here is flat to down, so very benign inflation on a year-over-year basis, and that's what we saw in those components in that first slide that we talked about inflation. Core services inflation has been running hotter consistently for several years now. The trend line continues to be down, even though we did see a blip up for several months at the beginning of the year, and that has reversed itself for the time being. And so it's getting us down closer to kind of those interim trough levels that we saw right at the beginning of the year. Now we look at some of those components here. So beef prices, as I mentioned, almost not quite a parabolic rise, but a very stark increase. And you just have to go price out briskets and flank steaks for fajitas and things like that, and you'll see very clearly beef prices are well above where they were a year ago. Airline fares, we've seen some consistent traction here in overall increases. Some of that has to do with energy prices for sure, but other things as well. And so we saw a little bit of a bump there. Medical services, which had been trending higher, is on the way down as we see a little bit of a kind of a fishhook downturn here in hotel, motel components into the consumer price index. We look at software, however, and computers and peripherals, and those are the areas that, oddly enough, these are experiencing pretty strong inflation right now. You can see that clearly in software and also here in the computers peripherals. This is an area that you typically see, as would be indicated by these two charts, you typically see price declines as technology becomes more mainstream. Just think about everything that's been in our lives, from phones to TVs to portable electronics. All of those things tend to come down in price over time, but we're clearly not seeing that right now. Rent inflation, very importantly, a big component of inflation, I should say, has been trending down. You can see its impact right now, about 0.3%, both on the OER, owner's equivalent rent, as well as rent to primary resident. So not maybe a little sticky here from a calculation standpoint, but overall trend remains down. And then over here from Charlie Blello, we have the monthly national rent. This is a median rent, and it's remained negative for quite some time. You've got to go back to 2023 when that, basically the beginning of 2023 when that rent was increasing, and that was at the tail end of all of that inflation that we had in 2021 heading into 2022. Now we talk about producer prices, the headline PPI. As we talk about this number, the year-over-year number 4.7 is basically flat for July. That was better than expected. We're looking for a little bit of an increase. You can see producer prices converse to what we see in some of the core, the core PPI here, conversely to what we see with core CPI prices or consumer prices. These have been trending up for some time, both on the headline basis and the core, which also excludes food and energy. But more recently, we've seen a little bit of a downtick in each of these components. So as we think about like the overall or the aggregate level of inflation, we're still 4.2 in the core, 4.7 on the headline, well above targeted levels. And it remains a headwind for businesses, and they've got to make that business decision. Or they're going to try to pass that through to the consumers to recoup their margin, or they're going to absorb it to remain price competitive. And here, let's break that down into goods and services. So you've got goods and then core goods here. You can see the goods number was actually a little bit better. So we saw a reversal of some higher levels that we saw earlier this year. On the core goods side, if you back out back out food and energy, you get to a point where it's benign. And we've seen some consistent growth, and you've seen more pronounced growth here in 2025. But the latest readings were down, and then services that has remained high just took a little bit of a leg down here in the most recent reading. Now, looking at this kind of taking two steps back and looking at it from at least the Fed's point of view, we've been hearing consistently that we being the Fed, wants to have a 2% inflation rate. And this is the CPI that this chart is referring to. The Fed's really talking about PCE, which is personal consumption expenditures, which is just calculated differently than CPI. But that being said, this blue line represents what that 2% inflation trend would look like if it was linear and it didn't change and fluctuate dating back to January of 2020, right before the pandemic. Red line represents where we are now and what actually happened. And so you can see very early on, post-pandemic, when the world kind of opened back up and we got a little bit more traction, that this has been running hotter consistently since that time. And so, this chart shows you that basically the CPI number, the index number, based on actual performance of inflation relative to the baseline 2% that the Fed has targeted, that overall inflation is 13% higher than that. And again, you can call this kind of failed Fed policy, but it just goes to show you the difficulty from a policy standpoint to rein in inflation once it gets hot. You can kill the economy by doing it and send the economy into recession. But again, the Fed's other mandate is for stable employment, and that has been a little bit more consistent. But you've got to kind of pick your poison sometimes, and clearly the Fed has not been able to achieve its targeted rate of inflation. Now we have the Atlanta Fed GDP now, and this is this is their index or their gauge of projected economic performance. You can see here this is the current quarter, and right now they're looking for about 4.3. And it wasn't too long ago that we were talking about 6%, but recent data has come in maybe not as supportive for that growth. Again, we just talked about how tariff refunds are contributing to near-term growth, and so it's actually all helping to put growth in that 4 to 5.5% broad range, even though those estimates coming out of this particular calculation are coming down. That being said, we've got the blue chip consensus that are still well below that. So this represents Goldman Sachs, Morgan Stanley, JP Morgan, all of those folks, still a bit more pessimistic insofar as the current quarter's growth is concerned. Now we'll talk about budget deficits. Another disconcerting topic for me, just because we're looking at some pretty stout deficits here, 430 billion, and you can see how that's played out, going back into the middle part of the last decade, and consistent deficits all along, but they seem to be escalating to some degree. And so you can see that here. This is a trailing 12-month federal budget deficit, and it's over 5%. And again, this is not sustainable. This has a lot of basically tangents into like debt issuance. And then from a treasury standpoint, you've got to determine, do I want to issue long-term debt, short-term debt? What is this going to do for long-term projected growth? And what is it going to do for inflation? If you're continuing to inject liquidity in here by printing money. Again, these are concerns that are helping to fuel higher long-term interest rates right now, and potentially creating a lot of interest rate volatility, or at least the persistency of interest rate volatility that frankly we've already seen a lot of over the last several years. And so interest rates being more volatile, we'll see in a second what the implications of that are for federal debt issuance. So here we have just a stark reminder of how deficit spending works, and the raw mechanics of it. Now this goes back to 2016, back when we could say that we had a fairly benign deficit, and those unfortunately were increased over time. We had the pandemic, then we had the stimulus related to the market downturns and inflation, et cetera. And so just over time, we're at a point now where we're generating 12-month tax revenue in the basically in the trillions here, and that is well below the government spending level here. And you can see, if you kind of think into this and kind of like mute out some of the noise here, that the trend lines are actually show continued expansion of that delta. And again, you've got to bridge that gap somehow, and you're going to do that with Treasury issuance and increasing your national debt. Trade policy uncertainty at least has come down. We have had some tariff announcements, trying to look at it from a different perspective, where you've got national concerns over labor displacement, or there are levers that the administration is using that probably have better staying power from a court's point of view. So we are seeing increased tariffs, but at least the policy uncertainty is coming down, but it's still elevated relative to clearly what we've seen over a longer period of time. Economic surprises. We had consistently seen positive surprises, and this is part of the euphoria that's been helping this melt up in the market, even though it's been a narrowly led market melt up. But we've had hard data. This represents the actual orders and data that is visible, that can be measured. Now, the soft data represents sentiment. It represents surveys, things like that. That's been softer, and was certainly soft coming into the year. The data from a survey standpoint has improved as we've seen more optimism in the overall economy, but you can see hard data has kind of tailed off just a little bit, whereas soft data seems to be picking up. Atlanta Fed, the wages as they're measured, a little bit of a tick up here. You can see that in the job switcher minus job stayer. So you've got wages that had been moving down with a little bit of hiccups here. I'd say the overall trend is still down, but when you look at overall levels of inflation and you think about unit earnings or average hourly earnings, are still below inflation. So real wages are negative, and again, wage inflation can be very sticky, and so current levels are still above what we saw in the last decade, but the overall trend, even with this uptick here, is down. Savings rates, we've updated you on this a few times. Again, you go back to 1950, and then you get in Great Society here, and then obviously you have high inflation exiting the 70s, and then this this consistent decline in interest rates, which made cost of capital very cheap, or increasingly cheap, and then so savings rates declined over those ensuing decades. And then we got to the new century here with noise around the pandemic, and now we revisit savings rates that are close to these global financial crisis lows. And again, when you back that out, I mean, there's really nothing in the time series that puts us where we are now, except for the bounce back or the reflex coming out of the pandemic here. Well, now we're going to transition into the investment markets, and as I always say, if you know, fundamentals play themselves out over longer periods of time. Sentiment tends to have more influence in the short run. Again, you look at the long term of the stock market, this is the S&P 500, and if you had responded or catered to emotional impulses like COVID pandemic. Again, a lot of books are written on how to buy the market. Very few books are written on how to sell the market, and oftentimes you sell at the most inopportune time because the behavioral impulses are on value declines are much more impactful than the elation that you get when it goes up. You can see, it's gone up for quite a while. 2022, we know, was an extremely difficult year overall for both the equity and fixed income markets. However, if you had bet against these things, and had been slow to get back in the market, you would have absolutely been, had lost a considerable amount of gains in the market. And so where do we stand right now with this melt up? Well, oddly enough, risk appetite is pretty high. We've got, say, certainly positive. And then the near-term outlook for the market is better. And again, this data oscillates quite a bit. So it could be quite different if we were to measure this about 2 weeks from now. So, but optimism is high despite the fact that we've been in this kind of clear melt up over the last 6 months. Now we look at smart money versus dumb money. I don't look at this that often, but you've got smart money represents institutional buyers. Dumb money, as it's defined here, kind of represents retail investors, and I think that's not giving retail investors probably enough credit. But you can see here, dumb money is more optimistic than the smart money is right now, and you've got smart money that's maybe raising a little bit of cash here. So anyway, there's just a dynamic that I think is. It's important to follow every once in a while just to kind of get a sense of where that's coming in. Again, we've got melt ups in the market, still moving higher. In the retail market, again, retail investors kind of like are equated, at least in this definition, as the dumb money investors. And you can see that they're putting more money into the market right now. Now we talk about the sources of growth, and again, this has not been just a U.S. Type of thing. We've seen growth elsewhere, but oddly enough, the theme is relatively similar. That we have actually had price to earnings multiple contraction, and think about that. With rare exception, Japan and the EMU have had a little bit of multiple expansion, but we've actually had multiple contraction of both, on the overall global sphere, China, emerging markets, and then clearly the S&P, even though it doesn't feel like it because the market's going up, but that's because earnings have been very strong, not only in the U.S. but across the world, and as a result of the optimism and the earnings, what we see here is that we've got 72% of S&P 500 members are above their 200-day moving averages. And when you take a step back and say, well, what does this mean? This means that you have, oddly, relatively strong participation in your melt up. Now, again, when you get up to 80%, that is very strong participation. And when you think about a couple of years ago, we were talking about the Mag 7 and how they were the only ones going up, but still we've seen the average constituent stock within the S&P 500 has had some very large drawdowns, whereas some of the semiconductor stocks, have witnessed fairly strong year-to-date gains, but the intra-stock, or I should say the intra-index volatility has been pretty high, even though the overall index volatility has not been as high. But again, a lot of broad participation in the market here. And as a corollary to the melt-up that we just talked about, and the earnings growth that we've seen, and certainly the estimates looking ahead in that regard, this slide really speaks to that as well. So again, almost 77% of companies have beat the analyst estimates in their quarterly reports this particular season. You can see technology has had a pretty strong beat rate, as has industrials and healthcare and real estate. And I'd say that really anything above like 75% indicates a relatively strong beat rate. And here we've got the percentage of companies that are actually raising their guidance. You've got 15.4%. Again, you've got the same group here, by and large, that continue to be much more optimistic looking ahead. This in particular is really fueling the overall increase in earnings estimates, which are helping to fuel this melt up. And actually, with earnings that are moving higher than stock prices, that is actually bringing that price to earnings multiple down. This chart here really kind of puts the words into pictures here. You can see, as I use this term parabolic, this really is an amazing increase in earnings. So you can see, going back to the beginning of the century, the line of best fit looks something a lot like that. And so this change over the last couple of years has been pretty profound. And you can see the rate of gain that we just talked about is fairly unusual. I mean, you typically have large percentage gains, but only after you have downturns. Like here's in the aftermath of the global financial crisis, when earnings estimates went down, and then they snapped back up once we exited that period. Again, here's the pandemic, same deal. Forward PE. Now, this is something else that we've been watching too, is that you've got the world ex-US trading around 15 times earnings, and the US trading a little bit over 20. Again, that multiples come down a little bit because earnings have been strong, but we still have that value gap of 5 multiple points between US and non-US stocks. And that gap has remained very wide for quite a while. Again, you got to go back, to basically the beginning of the century, or this particular century, to find some increasing disparity between those two. But U.S. trades at a premium. I would say that the world U.S. ex-U.S. is probably not. It probably has some value to it. It's not aggressively cheap, but again, there's a reason why we want to have global diversification, because there's greater value in international markets. Here we have the volatility indicators. One thing to consider, this is a 10-year average, and this kind of light gray here. And what it tells us is it's not atypical when you get into the early fall season, September, October, to have increased volatility. And typically these are some of the worst months of the average market year when you get into the fall. People are back from vacations, and there's kind of you're reconciling what has taken place over 2 full quarters worth of earnings reports and expectations that are delivered by companies, et cetera. So typically volatility picks up, and this is proving, ironically, to be a fairly consistent year with that. The blue line here represents 2026, and then again, this gray line represents the 10-year average. So I would expect volatility to pick up before it calms back down again by the end of the year. Again, pending developments in Washington and Iran, etc. I've talked about this a lot, and I think it really has some relevance as we look into what the investment landscape is going to look like over the next 5 to 10 years, even for kind of the average mass affluent investor. So, I've talked a lot about how the number of companies, again, this is going back to 2000, it was about 6,000. If you go back to the mid 90s, it was actually something more like 8,300. And, we've come down consistently over time. This represents the number of public companies that are trading on all indices. The left side just gives you a breakdown between small, mid, and large cap. Again, much fewer large cap companies than there are small and mid cap. You've got a lot of companies that are public here that actually aren't making money, particularly on the small cap side. We know already that within the Russell 2000 that 40% of those companies don't make money, but you can see just overall, we've had a decline in the number of investable publicly traded equities. At the same time, however, that we've seen this continued rise in private equity backed companies. And I call this kind of the investable set of private companies has gone up considerably. What does that mean? It just means that your investment options set here for private companies is expanding at a much greater rate than the investable opportunity set for public equities. And so what the implications of that are is that for the average portfolio, you're going to want to have some exposure to this area. And good news is that unlike 20 years ago, when you had to have a minimum investment of probably $1 million and you had to get into a private fund, a lot of this has been democratized and commoditized to where the average mass affluent investor can participate to some degree in this investment class. Initial public offerings have been sluggish for a number of years. We've seen a little bit of an uptick year to date. We've seen a big surge. Obviously, SpaceX has been a part of that. Now, we've got Anduril, we've got some of these other very large mega IPOs that are teed up in the wake of SpaceX. But again, this could help to change the calculus. Whereas, if you go back, for quite a number of years, we just frankly haven't had as many IPOs that we did in the 1990s when we started to kind of witness the expansion of e-commerce, internet, that whole theme. And so hopefully we're on the cusp of an increase in equity supply. Here we have crude oil. This is kind of the, all that you need to know in one chart. And so we look at several things here. So crude oil stocks as they stand here today are kind of right at the bottom of their 5-year range, which is that shaded part. Gasoline stocks are pretty low. Distillate stocks like kerosene, heating oil, etc., are pretty low. Strait of Hormuz, daily ship crossings, we know have basically fallen off a cliff. We were kind of like taunted with the interim ceasefire agreement, which has largely gone by the wayside now. And so we saw a little bit of tick up in activity, ships crossing. Again, these are ships that actually have their transponders on. There's a lot of data that's probably not being captured, honestly, because ships don't want to be tracked. They want to get through and turn off their transponder, and so it's hard to track those people. But needless to say, there's been a considerable drop off, as we all know. And here we have basically the lost exports and how that's kind of translated. This seems pretty stark, but there have been some workarounds. We've rerouted some crude through Strait of Alibaba, which now is under probably some risk from the Houthi rebels. We've got lower imports from China, which is a very large importer of Middle Eastern crude. You've had some releases from reserves within the IEA, and then a little bit of production increase, and then your net shortfall still is recognizable. It's causing energy prices to remain high, but when you net all of these kind of like offsets here out, the drop is not quite as macabre as it sounds. Well, with that being said, the crude oil inventories, as we see here, have really dropped off. And again, I do think that this remains a risk to the market just because when your supplies are low, including your Strategic Petroleum Reserve, your SPR, that is creating a scenario where you might have the risk of a price shock. Gasoline prices, as we see here in the black line, represents 2026. This far into the season, it's about as high as we've seen it, except for 2022, which, as we all remember, we were dealing with pretty high inflation at that point. So gas prices, when you go back to 2004, basically over 20 years worth of observable data, obviously we're tracking higher than that. So as we exit the driving season, that is clearly an issue for consumers. We got gold futures. We've had big run up in gold, kind of leading into the first part of this year, and then we had that big reset that reminded everybody just how volatile gold can be and how at various times it does not provide adequate diversification. But we've seen a more recent bid on gold, and now it's punched through its 100-day moving average price, which technically would tend to indicate that it's going to continue to move higher. But we see a little bit of the dynamics over here on this side, and this is going to require a little bit of explanation. So these are options, and it's implied volatility based on the demand for those options. So here, as we saw 2026, we had an increasing demand for puts, for downside protection as prices were coming down. And lately that's reversed itself. So we have more expensive calls than puts. And what that means is that there's an increased demand for basically an increase in demand for upside exposure, and so prices of options represent the compensation for volatility, and so we just see that with this drawdown and snapback, that volatility overall has increased. Now we'll talk about treasuries, and I alluded to this before. We've got a Treasury Department that is increasingly relying on T-bills, short-term instruments. And what this means, the implications here are that as interest rates potentially move higher, the borrowing costs for the Fed on these short-term notes, when they have to get refinanced, are going to be more expensive. And right now, we've got 22% of our marketable debt, our treasury debt, is in T-bills, and you can see that it has been that high previously. A global financial crisis, you're in really an existential crisis of confidence here, and so you're issuing as much short-term debt as you can, because back then rates went to zero and it was very cheap. COVID, same deal. That's why you wanted to do it, but rates are much higher now. And so the question is, are you getting yourself into a pickle by increasing short-term rates and then exposing yourself to higher refinancing costs? And at the same time, we have an increasing fear of inflation, of higher costs down the road through all of the levers that are being pulled, and also this concern over the pace of our federal deficits and our overall borrowing, et cetera, and that's driving up the cost of long-term treasury debt as well. So you've had kind of a steepening in the yield curve, but we haven't seen 5% yields on new issue 30-year treasuries since 2001. And this is a pretty strong development. This is your bond market telling you that it's losing some confidence in the ability to control and contain inflation. AI issuance, at least in the investment grade sector, um, is really high. That's we've seen this represents the percentage of investment grade 10-year supply that is tied up in AI, and that's basically about 40% almost. And again, that's just represents a huge increase over the last several years. Credit spreads are they've been extremely tight lately. And you go back to like triple C's. I mean, these as you go across this line here, you get into increasingly speculative levels, and triple C's represent a high probability of default, and so naturally spreads should be widening out as you go along the credit curve here. But if you look at single A, triple B, which are all investment grade, these things are trading really, really tight. And you can see some of these other examples here where you've got fixed income spreads they're still relatively tight from a option adjusted spread basis or OAS basis. We've got default activity. We did see an uptick in that. We do see like high yield bonds that are kind of sticky, maybe upticking a little bit, but overall leverage loans are coming down. If you look at defaults versus distressed situations where you're basically in non-compliance with your debt covenants, and this obviously represents where these loans have actually just flat gone bad and in non-payment, etc. We've actually come down a little bit on defaults. This represents year to date, so I would say you could just multiply that by 2. But if you did, you'd still be kind of in a multi-year decline, which would seem to kind of like dovetail a little bit with the moderation that we saw here coming out of 2022. Interest rate expectations, I think, we're in a very interesting spot. We came into the year expecting multiple rate cuts. That was baked into the market. I think it's astounding that we've gone from this expectation to this expectation, and we haven't had a 10 to 15% correction in the market. I think it's absolutely astounding because this has been a sea change in sentiment related to interest rates. Now with the CPI data coming in, the inflation data coming in somewhat benign from an expectation standpoint, maybe there's some of the steam that's been taken off of this. Now I think certainly the rate increase for September is off the table. Markets are still pricing in a December increase as indicated here, but then you can see what we were talking about before with higher, auction rates for new 30-year treasuries. You can see, basically upward pressure on the long end because of fiscal problems. I mentioned that, the deficit, the amount of long-term debt, the interest rate on that long-term debt, etc. We've got corporate issuance, particularly from AI that we just looked at. That's putting upward pressure on what we call the belly or the middle part of the curve, like the 5 to 10 year part of the curve, and then higher inflation driving up the low end of the curve from the expectation that was embedded coming into the year. Here we have investment grade issuance overall surging, and then here's that hyperscaler issuance that is going through the roof, and again creating some speculation now as to whether they're going to be able to generate, once they deploy this and invest this and build capacity, are they going to be able to generate the returns that are going to provide an adequate rate of return to cover that debt service on this new issuance? And that's the big unknown right now. But we see that debt issuance has increased, and a lot of it's coming from the hyperscalers. And we'll end on something I find of interest. I've got a son who's very much a movie person, and here we have weekly movie theater visits that have gone through the roof. You've got Spider-Man and you've got the new Odyssey movie, which are driving that. So that is just one proxy that Torsten Slok at Apollo has pointed to say, listen, the consumer is not in terrible shape despite lower savings rates and credit card balances and higher rates on credit outstanding, and all of that is still, people are getting out and they're doing kind of like Americana things like going to see movies. And then data center capacity by state. I have no other interpretation of this other than to tell you that my home state here, Texas, has really gone crazy on data centers. We'll say that there's been a lot of press lately about the governor and really both sides of the aisle wanting to hit the pause button as we analyze, environmental issues, power concerns, all of that. But just highlight that Texas is very much, pushing the envelope on the data center and the AI theme. That's all we have this week. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.